Hi all, it's time for the latest edition of our recommended funds list for 2023-2024. This list of 46 funds in total have all delivered strong and consistent risk-adjusted returns and serves as a great guide for any investor looking to build a diversified portfolio, whether you're a new investor or a seasoned investor. 2022 was one of the worst years in recent history for global bonds, as a sharp pace of Fed rate hikes pushed yields much higher. Many balanced portfolios were not spared as well, with equity markets taking a beating as well. But these tough market conditions have allowed fund managers to truly showcase their skills by remaining more resilient than their peers. The uncertain macro environment ahead means that it's even more crucial for investors to select the most capable fund managers who can expertly navigate different markets. This table contains 11 fixed income strategies and 2 balanced strategies, all of which are our top picks within their respective categories. Any changes from the previous year are bolded and highlighted, and we'll explain our rationale for some of these changes in the subsequent slides. Our first new inclusion is the Manulife Asia Pacific Investment Grade Bond Fund. This fund uses a combination of top-down and bottom-up research, and also adopts a multi-pronged approach to generate returns through interest rate strategies, credit positioning, and active FX management. The fund manager has expressed caution on China's uneven path to recovery and doubt on the potential effect of demand-side stimulus. We think this may have contributed to their underweight in China. As a research team, we have also expressed our negativity on Chinese markets for longer-term structural reasons as well, and we think this China underweight looks well warranted. One interesting trait about this fund is its active FX management. The fund has committed to maintain a minimum 70 exposure to the SGD after hedging, and this is reflected by its composite benchmark too. But its current FX exposure is heavily overweight the SGD at 89%, way above this minimum 70%. And this is partially funded by a large 5.1% underweight to the renminbi. We think that the Manulife Asia Pacific Investment Grade Bond Fund has displayed its ability to navigate the diverse Asian IG market. And this is most evident from its superior performance on a 1-year, 3-year, and 5-year basis, as well as its downside risk management through a lower maximum drawdown than its peers. Our next new inclusion is the Schroder ISF Asian Local Currency Bond AEC-USD, which is our recommendation for the Asian local currency bond market. One thing to highlight about this fund is that similar to the previous Manulife fund, it also has a slight underweight to China, with overweights to South Korea and Indonesia. This Schroder's fund has also greatly outperformed its Asian local currency bond fund peers, and this outperformance is most stark over a 5-year horizon. It has also displayed a below-average maximum drawdown. The third new inclusion today is the PIMCO Emerging Markets Bond Fund Class E SGD-H, our recommendation for the EM hard currency space. This fund employs a top-down and bottom-up approach with a heavy emphasis on quantitative rigor, while the fund manager has also expressed a preference for quality bonds. We think this PIMCO fund has clearly displayed stronger returns relative to its peers, once again most apparent on a longer-term 5-year horizon while maintaining a lower-than-average maximum drawdown. Before we move into the next new inclusion, let's talk about some streamlining changes we made to the overall recommended funds list. Our first key change was to change our money market short duration category to just money market. We did this because money market funds tend to have distinctly lower durations compared to short duration bond funds. One of our existing recommendations, Nikko AM Shenton Short-Term Bond SGD, has found a new place in our recommended funds list because of this, moving to the Singapore-centric category, which we feel better reflects its fund characteristics. Meanwhile, the United SGD Fund Class A SGD continues to be another one of our recommendations within this Singapore-centric category. Another streamlining change was to narrow down our global fund category to just one recommendation, the Allianz Global Opportunistic Bond Class AMG DIS H2 SGD Fund, which is once again our recommended global bond fund this year. This is an unconstrained all-weather strategy with significant flexibility in duration exposure as well as the types of fixed income assets. In contrast, our previous Fidelity recommendation typically kept duration within plus minus 1.5 years of benchmark. We think this flexible approach of the Allianz GOB fund could be a strength in these uncertain times, especially considering the fund managers have already displayed a good track record in outperforming the global bond market. Let us now move back to another newly recommended fund this year, the Fullerton SGD Cash Fund A SGD, within the newly minted money market category. This fund primarily invests in deposits of maturities of up to 1 year, with a gross indicative yield of about 4%, coupled with a fairly low expense ratio of 0.15%. Its downside risk management has been exceptional, with a maximum drawdown of minus 0.005% over the past 5 years, and this number really underscores its resilient nature. This fund also features as the largest allocation within our very own SGD Auto Sweep, which allows investors to use their Auto Sweep monies immediately for investment. The fund on its own has a relatively short settlement schedule as well, of T+1 for redemptions, compared to many other money market and short duration bond funds which typically have schedules of T+2 to T+4. With this in mind, the Fullerton SGD Cash Fund A SGD continues to provide very good liquidity at an attractive yield for investors looking to park their money while still looking out for market opportunities. With that, we have covered most of the changes to our recommended funds. One common thread across all our recommended funds is our strong emphasis on long-term performance track record rather than just short-term market conditions. We think our new recommended funds 2023-2024 can serve as a good guide for any investor wherever you are in your investing journey.